Okay, so this part of the newsletter, I'm going to go over a bunch of stocks that I like, and you'll start seeing some similarities in all of the stocks, from their stock chart to their fundamentals, what each company does. And this should pave the way to make you able to spot investments in the future, because you're not always going to be able to rely on some newsletter or some person on the internet. That's not what you're going to want to do. And that's not what this investment newsletter and this course is about. It's about kind of priming you to be able to pick your own investments in the future without the help of anybody. Just learning the basic fundamentals here that I'm talking about on this video newsletter should prepare you to pick your own investments. Now, before we talk about some of the stocks I like and the qualities of these companies and why I like them, I want to talk about what not to invest in. And I know you've heard me in the past say that you should not invest in the financial sector. And you may not really understand the reason why. You may say, well, what if there's some good companies in the financial sector, just like there's good companies like, say, Apple in the tech sector? You know, why should we just abandon this sector? And I'll explain the reason why. And when you hear the reason, it'll start to make sense. Well, first of all, I'll just go over the long-term returns in the sector. Here's a chart of the banking index. This is basically the KBW Bank Index. It's just a bunch of the main financial institutions created into an index. So it's called the KBW Bank Index. And what you'll notice here on this chart is that pretty much in the past 20 years, the stock chart has done nothing, meaning that all the companies as a whole that make up this index have pretty much returned nothing for shareholders, and the real return is negative, because if you would have invested, say, in the mid-1990s in just a simple bond fund, or just bonds in general, you would have made a much better return. It would have been a positive return. This is a 0% return. This is nothing. So you're losing out to inflation over the past 20 years, so your real return is negative. Now, people may ask, okay, why do we just abandon the financial sector? Well, there's a few reasons. One of the main reasons is banking institutions deal in derivatives a lot, and a lot of times they announce these write-offs and these charges to earnings. Trading revenue could plunge. They could take a big charge, and J.P. Morgan did just this with the London whale trade. You heard about that, because most CEOs in these banking institutions, they do not even know what their bank is doing. They have no clue. The banks are pretty much too big. They're too interconnected to manage. But this isn't the reason why I don't invest in the banking sector. The reason I don't invest in it is because banks do not sell a product that differentiates themselves from one another. Therefore, every company in the index is going to move in tandem with each other. So whatever the index pretty much does, you could pretty much be sure that's what each company is going to do. So if you look at the chart of, say, this KBW Bank Index, and then you look at any other bank stock, they're pretty much going to have the same type chart. The reason is a company like Apple Computer sells a product. So you could differentiate that product with another tech company, say a Dell computer. So, Apple has much better returns than Dell over the previous, decade, because the product is so much better. But the difference in banks is very hard, because banks really could only differentiate themselves to a point with products, but most of it, they all make money the same way. They play off a spread, which is called the net interest margin. And that's what the banks borrow money at, and then what the banks lend money at. And it's called the net interest margin, or the spread. So banks borrow short-term and lend long-term. So they'll borrow short-term money, but then they'll lend it out for a 30-year mortgage for someone on a house. So they borrow short-term, lend long-term. That's the whole business model of banking. And it's called the net interest margin. And banks can't really differentiate themselves along the lines of the net interest margin, because they're beholden to what interest rates are doing, what the yield curve is doing. So there's really no product that they sell. Now, they could get into insurance and things like that, but the way they differentiate themselves is they try to get crazy with trading departments and stuff like that, and they end up speculating. And that's why there's always this inherent built-up risk in banking because what they do is they want to make more money than their competitors, but they can't. They can't do it the normal way because, banking is a pretty much an old, stodgy way of making money. It's a pretty much old economy way. It's not really a growth industry. So they end up creating crazy products, things that end up going bust 10, 20 years later. And that's why banking is a boom-bust sector. Because the people that run the banks are only human and they have a psychological tendency to want to gamble and outdo their competitors. Now, there's a few banks that are doing things right, but I just fear in the future they might go down the same path that classic banking always goes down, which is to end up going bust after you boom. And one of those banks I really like is TD Bank. And you could see TD Bank is just destroying every bank. I mean, they were the first bank that I said many years ago will be probably the best performing bank because they were open on the weekends. Most banks were just open when people were working, so people couldn't really get to a bank. So it just made no sense. I always said the first person who starts a bank that's open on weekends, is going to be the first bank that actually is successful. And I don't know why it took the banking industry so long to realize this. And it just goes to show you, if these banking executives aren't smart enough to realize that they need to be open on the weekend, why would you invest in their companies? If they're not smart enough to make that decision, what in the world makes you think they'll be smart enough to make investment decisions? They're terrible. Most people that run banks, they pretty much don't know what they're doing. They're total failures. They rape the companies with stock options and pay packages, and they pay themselves exorbitant amounts of money by siphoning off money from the shareholders. So banking long term is a terrible business. And I feel that TD Bank, although I love the bank and it's a great performing stock, pays a nice dividend, the reason I will not invest in it is because I fear in the future that it's going to go the same way as Bank of America. They're going to lose their way. They're going to get some greedy CEO to run the company. Sooner or later, I mean, that's pretty much a given. A greedy CEO will, at any one time, run a certain company that's good, and he'll come in and destroy the company. But sometimes it doesn't matter how bad a CEO is. If you have a good company behind it, the CEO will just end up becoming fired by shareholders, and the company will bounce back. But with banking, you can't bounce back because the losses are so huge, because the losses are leveraged. When you have leveraged losses, it's pretty much impossible to come back. And that's why you see all these banks are just terrible long-term investments, because management has made just terrible decisions. They gambled in the housing market. They just went crazy with leverage. They just destroyed shareholders. And this is just one index, you don't need to invest in. You don't have rules like a mutual fund does. And mutual funds, they have rules. They have to keep a certain percentage of their money invested in any one sector. So say they need to own, say, 15% of their clients' money in the financial sector. So even though they may not like the financial sector, by rules, by the law, they have to keep a certain amount of money weighted in the financial sector. And this is why if you don't invest in mutual funds, you could actually do a lot better, because you could just avoid the sectors that are terrible and have horrible long-term economics to them. And over the long term, you'll do better than most mutual funds, and you'll do better than the index. I don't know why so many people say it's so hard to beat the index. It's not. If you're an individual investor, beating the index is not hard over the long term. It's actually pretty simple. For a mutual fund manager and mutual funds, it's hard to beat the index because you have to invest in crappy industries. That's why Warren Buffett pretty much over the long term has always beat the S&P 500. He's pretty much stayed, obviously, with businesses he knows, but most of his businesses are in the consumer goods department. And yeah, he made his money on a lot of different financial products, but it wasn't banking, it was insurance. Insurance is a much different industry. He made most of his money with Geico in the beginning, and then See's Candy, which is a basic candy company, and then over the past decades, Coca-Cola. Now he's big into Wells Fargo and American Express, but look what happened with those companies during the 2008 collapse. They pretty much, collapsed 70 or 80%. So, he's not really making much money with those companies. He made all his money with, consumer goods companies. So you could beat the index, pretty easily if you stick to, pretty much the stocks I'll talk about in this newsletter. And I'm not, these aren't all the stocks. These are just the stocks that I'll mention, coming up. These are basic stocks. They're not going to really make you rich in the short term, but they will grow your money over the long term. But you'll notice none of them are financial stocks. None of them are banking stocks. And, most of these companies are pretty much consumer staples and capital goods stocks. And I'll talk about them right now. And you'll start to see the similarity in all these companies where they all have a sustainable business model. And they've been around for a long time. So, again, stay away from the banking sector and you will do pretty good. Okay, so before I talk about individual stocks, I also want to make it a point to talk about total population. Now, this first chart you're looking at is total US population. Okay? It's probably safe to say that total population in the US is going to continue to rise. Now, when you get a rising population, this is why I recommend many consumer goods type stocks. Companies that sell a product that people have to keep buying. You'll see I'll talk about General Mills, which is a cereal, and we'll talk about different products that as the population grows, they're going to use these products more. And this is a key element when investing. Population growth. Most people do not calculate population growth into their analysis. So when you look ahead, when you look out 30 years, and I know many people can't really fathom holding on to stocks for that long, but most people are going to be holding stocks this long if they start investing, say, in their late 20s, 30s, or even 40s. If you invest in your 40s, you're probably going to live into your 70s, and that's 30 years. So even if you hold just an index fund, this population growth is going to make all these company earnings rise in the future. And as the future keeps coming and more years keep passing and the population grows, people get older, they're going to keep consuming these products. Now, it's not just the United States. This next chart is the estimated global population by 2050. And this is from the Pew Research Center. And again, you could see it growing. So right now it shows about, around 7 billion people. But by 2050, which is pretty much about, 30, 35 years, from now, we're talking about almost 10 billion population. So this is huge. Putting this into a company's earnings, all these extra people, these companies are just going to be making massive more amounts of money from the total population growth. And then from population, like I said, you get, more people need a place to live. So real estate, building products, the Home Depots, all these type of companies throughout the future are going to be making so much more money. So population growth is definitely something that everybody needs to take into account. Now, if the population was declining over the long term, I would be reluctant to invest in, many of the companies that I'll be recommending. But this is not the case. The population is going to keep growing. And look, this is just estimated. There could be prosperity ahead where people end up having even, more children in the future. As the world becomes much more prosperous, they'll start having more money, being able to buy more things for their children and their families, kind of upgrade to different, whether it be they'll be wearing better clothes, eating better food, buying better consumer products. And like I said, this all factors into the stocks that we're about to talk about. So population growth, keep this on the radar. This is huge. It's not something you can really look at on a year-to-year basis because the population really doesn't grow that fast. But when you look at the long-term trends, you could pretty much see that we're going to be a lot higher than we are today. Okay, so now I'm going to talk about some stocks that I think are very good long-term investments. They have good financials, good fundamentals, they're in a good industry, and they're run by good management. And they should be able to sell products pretty much for the next 100 years. The products that they sell are not disappearing, okay? Now, the first stock I want to talk about is a company called Badger Meter. Actually, this company is in the technology sector. It's in the scientific and technical instruments industry. What they do is they make meters like water flow control meters, like, those electrical meters on the side of your house. Well, they make all these different metering devices, but they're adding a lot of technology into these meters, like smart meters. It's incredible the things they're doing. Okay, now Badger Meter it was established in 1905. So this is a company that's been around for a real long time, and it's going to continue to be around for a long time. And they don't just make products that control, say, like your electrical meter. They control flow of liquids, including water, oil, different chemicals. On a chart here, just look at the earnings per share numbers. They've been going up pretty much steadily since 2004. There's been some hiccups in a few years, but these are from different things, whether it be acquisitions. Again, the earnings per share number, you can never just look at that. You got to look at overall sales growth and different things. But they basically manufacture all these flow measurement, control technology products, and worldwide. They offer mechanical, electronic water meters, related technology service to municipal water utilities, products that measure control meters flowing through a pipe or a pipeline, such as water, air, steam, oil, and other liquids and gases in the water and wastewater, oil, gas, chemical, food and beverage, pharmaceutical industry. I mean, they're everywhere. Heating, ventilation, air conditioning industries. They also sell radio technology to natural gas utilities for installation of they've special gas meters and different concrete vibration things. They serve water utilities, commercial and industrial. I mean, they're all over the place, and they're only an $800 million company, meaning their market cap is $800 million. So this is a company that has a big potential to make shareholders wealthy over the next 20 years. If you have a $100 billion company, it's very hard to double your sales. When you have an $800 million company like this, you could double or triple or quadruple your sales in a pretty short amount of time. Badger Meter has a forward PE ratio of 22, which is pretty good. I mean, you always have to look at what its growth rate is. So is 20. You never want to kind of pay more than 2 times growth, but it depends. It depends what industry the company's in, their order book, what they're doing, what their financials are. They have a return on equity of about 15%, which is very solid. They pay a 1.36% dividend, and you could also buy this stock direct. You could buy it through amstock.com. So go to amstock.com, you view all their plans, and when you buy a stock like Badger Meter directly, you're on the shareholders, you're a shareholder on their books, meaning that you don't have to worry about SIPC insurance, or if you own a bunch of stocks at a brokerage firm and the brokerage company goes under. You don't need a brokerage firm to buy this company. I own this company direct through amstock.com. I actually invest in it. You could do recurring purchases, and I add money to it every month. It actually automatically gets deducted out of my checking account, and it just goes into continually buying more shares of Badger Meter. I've been doing this for years, and it reinvests the dividend, and it just keeps growing and growing and growing. And it's an excellent company, and like I said, it's only an $800 million market cap company. So this has the potential to go up in value a lot. I mean, you look at the beginning, look at it in 1990, it was basically trading at $1 a share, and today it's at 50. So this is 50 times your money, and that's without the dividend reinvested. Now, Badger Meter never traded at $1. This is just split adjusted on the chart. So it was never trading at $1. In 1990, it was probably trading around $30 or $40 per share. But this is just, it's done numerous splits in the past, and that's what the chart is doing. And you'll see in most of these charts, when you see $1 or 60 cents a share, it never traded at 60 cents. So don't be running out trying to find stocks that are trading for 60 cents, like penny stocks, because this is what most people do. this is wrong. The company's never traded at that price. It's just split adjusted on the chart. So Badger Meter, definitely a good company to look at. Again, you have to do your own research. These are companies that I own. I'm here to give you the basic fundamentals of the company. I can't sit here and give a full valuation of every company. This would be a 20-hour newsletter, a book the size of Benjamin Graham's Security Analysis. You can't do that. This is just to get you started to where to look at, what good fundamentals look like. That's why I'm showing you the EPS numbers, the sales, the return on equity, talking about the forward PE ratios, the market cap, where you could buy it. It's just a primer on what these good companies look like, and you'll see that the charts start looking similar because, again, the chart represents the fundamentals. So Badger Meter, put this on your radar, investigate it more, and we'll talk about many more stocks to come. Flowserve is another one of these old industry type companies that have been around for a pretty long time. They've grown through making lots of acquisitions in the past. And like I was saying earlier, when you get recessions, the stronger companies usually buy out the weaker companies. And a lot of times the weaker companies are actually great companies that sell great products, but they were just kind of mismanaged maybe in the past. And then you get these other stronger companies buying them out, and then they start growing as a company, and they create these big industrial type companies, and they have a whole diversified line of excellent products, and they're just amazing companies to invest in. Flowserve is one of these companies. It's got about an $8 billion market cap. Again, these aren't huge behemoth companies that are 70, $80 billion companies. An $8 billion company, although on the larger side, it just leaves a lot of room for future growth, for future acquisitions. They have this company also, I noticed, trades a little bit more volatile than the other companies. But again, many of these stocks in this industrial type sector, they are much more volatile than, say, a consumer staples type stock that I'll talk about later on, like something like Colgate-Palmolive, which is a great company but much less volatile. But these companies are more volatile. They trade more with industrial production numbers and also the global economy. What's good? They're more economy oriented when economic numbers come out. But Flowserve has a forward PE right now of 15, which is actually very good. I think it's a pretty decent valuation. It's recently had a slight correction, which I like. I've been actually buying up shares. Its operating margins are about 16%. Its return on assets is about 10%, which is a fairly decent number. Also pays a 1% dividend. You could buy this company direct at Wells Fargo. The website is shareowneronline.com. You could buy shares direct, which is great. Like I said from the previous stock we were talking about. When you own direct, the shares are in your name. And the great thing is, it's not just in some brokerage account where you could log in the morning and sell shares at a moment's notice, and then towards the end of the day, you kind of regret it. This, you can log into the account and sell shares, but the sale takes place pretty much like a day later, and it's not as quick as a brokerage account with the streaming quotes and all that stuff. So I think it's better. And also, what I usually do is I take delivery of the physical stock certificate, so I can't sell my shares at a moment's notice. Usually sometimes you want to sell, and you sell, and then a day or two later, you kind of regret that sale. So when you own the actual physical stock certificate, usually you want to sell, then maybe the next day comes and it kind of passes, and you end up not selling. And it forces you to be a long-term holder. It forces you to be more of a business owner. And that's what investing is all about. It's all about owning pieces of a business. So again, Flowserve, basically, what does Flowserve do? Well, it basically designs, it manufactures, distributes, and services industrial flow management equipment. Okay, the company has an engineered products division. It offers, different custom products, engineered pumps and pump systems, mechanical seals. Like these special seals that this company makes are in big demand. It's got all these different systems, replacement parts, and other equipment. and the pump systems are amazing. They're some of the best in the industry. So they've the flow control division offers industrial valve and automation solutions and isolation and control valves, actuation controls, and all this other equipment, steam traps, boiler controls, and all this other stuff. And it's amazing. If you go to the website, I'm pretty sure it's flowserve.com. It's amazing. You'll see the industries that this company serves. I mean, it was founded in 1912, and its headquarters is in Texas. And it's amazing. I mean, the products, the engineering that goes into these type of companies, you can't just, a competitor can't just come along and compete with Flowserve. I mean, this is a company that over 100 years has built itself up. So look at Flowserve. This is an excellent company. Again, this is another company I own shares in, but do your own research. Again, this is a starting ground for different companies to look at. And it's an incredible company. Look to buy these type of companies on large corrections. They are volatile stocks, and you could see from the chart. But wait till they have big corrections. Companies like this do go through bear markets, and a lot of people start questioning if it's a good company or not. But they're fabulous companies. A company like Flowserve, and you wait for bear markets and corrections, and that's when you put in buys. And if you do a dividend reinvestment program direct through the transfer agent, like I was saying, from Wells Fargo, you could do recurring purchases, so you could add money to your investment every month. And I'm telling you, these companies are excellent long-term companies. 30 years from now, and that's if these companies don't get bought out, but 20 or 30 years from now, these companies are going to be so much higher. Fastenal is one of my favorite companies. Those who have followed me know that I've been talking about this company for many years. I think it has one of the best balance sheets out of all the companies I'm talking about on this newsletter. It's just an incredible company. What they do is they basically operate as a wholesaler and retailer of industrial and construction supplies. They actually have supply stores, Fastenal stores. They're in the United States, Canada, and also internationally. And what they do is they offer like fasteners and all these construction supplies under the Fastenal name. And their main products are like threaded fasteners such as bolts, nuts, screws, studs, and all these related washers that are used in manufactured products and building projects. And they also have maintenance and repair machines. And they're getting into this industrial vending where they set up vending machines at these companies, and instead of companies constantly ordering products and taking inventory and then putting in the order, well, Fastenal's vending machine is in there, and it tells them when the orders are running low, and then Fastenal workers come in and they resupply the vending machine. It could be with cleaning products, gloves, but their main thing is threaded fasteners. The profit margins are incredible. They have these big manufacturing facilities where they make all these custom products. I mean, if you just go to YouTube and type in Fastenal, you'll see what the company is about. It's incredible. And the financials, the balance sheet of this company are just incredible. It's a $12 billion company. So the market cap is $12 billion. Again, nothing crazy, nothing over 40 or 50 billion. So they could easily continue to grow in the future. It usually trades at a pretty high valuation, Fastenal, but right now the forward PE ratio is about 22, and I think this is actually fairly cheap for a company of this caliber. It's got zero debt. Zero debt. I mean, how many companies can you look at and say that they have zero long-term debt? It's incredible. Its return on assets is 21%. This is pretty much unheard of. Its operating margins are 20%, and this is with no debt. Usually when you look at the margins, that's, when you look at debt and everything and takes into account, 20%. Return on equity, 26%. Now, you could bump up your return on equity, and that's what many companies do by taking on debt. This company with no debt has 26% return on equity. Incredible. It also has a 2.3% dividend yield. I mean, it's just incredible. So you cannot buy this stock direct. You have to buy it through a broker. but it's just one of those companies. I think it's going to continue to do excellent in the future. This is a company I own a good amount of shares. I've been buying more on this correction. It's been having a recent correction. There was a write-up, I think it was in Bloomberg Business Week, that just type in Fastenal Bloomberg Business Week in Google, and they have an article. It's actually been the best performing stock since the 1987 crash. Better performing than Apple. And most people don't even know what this company is or what it does. And it's, even if you look at the chart pattern, which reflects the fundamentals, it hasn't really gotten ahead of itself. So it's not, I don't believe it's overvalued when it, a lot of these companies on a chart, they make these like climax top type patterns. It's not doing that on a logarithmic chart like you're seeing right here. It's just steady as you go, going up. And it may base out for another couple years, but it just makes it a longer time for you to build a position, and then it'll rocket higher. When the United States goes on another construction boom and industrial production picks up, and we have another big bull market and another big boom, maybe within the next few years, Fastenal is going to be one of the first companies out of the gate. There's many reports about the United States has some of the worst infrastructure, dying infrastructure, and Fastenal is going to be one of these companies that benefits from this trend the most. So look into this company if you want. Again, go to the company websites, listen to the conference calls, read the company's 10K. This is what I do. These are all things that you need to do to investigate companies and to research companies. Once you do that, you'll realize all these companies start having the same thing in common. I know the companies that I'm talking about now are moreover industrial companies, and I have one more to talk about, and then we'll go into different consumer companies. But these are companies that will make shareholders a lot of money in the future. Chicago Bridge and Iron is another company that I really like. One thing I want to say about this company before I talk about it is I only really like to buy shares in this company after they have large corrections. It's been having a nice correction recently, which is pretty good. I mean, it's almost cut in half. I would maybe like a little bit more of a correction, but the reason is because it's kind of a cyclical stock, and it goes with more of like industrial production numbers. It's an energy infrastructure play. So what happens is when, like you're seeing now, the price of oil and energy, natural gas is really down, kind of that cyclical industry, then this company might not do as well. But over the long term, it does well. What the company does, it makes like renewable electric generating plants for the power industry. It deals with upstream and downstream process facilities for the oil and gas industry. And they have a whole fabrication services segment where they're involved in the fabrication of piping systems. They deal with the erection of steel plate storage tanks, pressure vessels for the oil and gas, water and wastewater, mining, mineral processing. I mean, they're pretty much everywhere. Go to their website and you'll actually be amazed at the stuff this company does. It's a very interesting company. They have a lot of engineering expertise. I mean, again, you're not going to get competitors to really compete with these guys. These guys are incredible. They're about a $6 billion market cap. Has incredible return on equity of 26% that it posts pretty much year in and year out. Its forward PE ratio is only 9. It's really low. Many people may look at that as it's cheap. A lot of times you have to dig deeper into the numbers. It could be a value trap. They could have had really good earnings numbers right before a cyclical downturn. So it's inflating the E. So when you multiply the P divided by E, it's going to get a low number. So don't really look too much into the forward PE ratio. I look at what energy is going to do, when energy is going to start turning up. So I think actually oil may be bottoming pretty soon. So in essence, this stock might be a pretty decent buy right now. Do not make this a huge portion of your portfolio. And if you do buy over the period of many months. If you want to put an extremely small position, just buy 20% every 2 weeks of the position you want, because it's a very volatile stock. But it's an incredible company, has good financials, and I think long term it's an incredible company. I think even Warren Buffett bought this stock, or his traders. He has guys that money manage billions of dollars for him. They actually bought shares in this company. And I remember many years ago, after the 2008 collapse, I bought shares in this company. I sold most of them, and I look back, I think I sold too early, but I still own a few shares, and I'm probably going to start buying more shares of Chicago Bridge and Iron actually pretty soon. It's had a nice correction, and I really like what this company's been doing. And I think that this whole energy infrastructure type companies, especially with renewable electric generating plants, and they're making natural gas facilities, I think that over the long term, this company is, again, going to make shareholders really wealthy. And again, don't be swayed by the name. Just because it says Chicago, don't think that the company just deals with Chicago. I mean, this is a global company. This is an excellent company. They deal with all over the world. So their expertise, their engineering expertise, and they keep getting contracts for new stuff. So look into this company more. It's definitely a company I like, and it's definitely a company that's doing good things. So now I want to talk about two Vice stocks that I like. So what are Vice stocks? Well, Vice stocks are basically your alcohol stocks, cigarette stocks, gambling stocks. These are companies that could make shareholders extremely wealthy if you pick the right stock. So the first one I'll talk about is Altria. I've been recommending Altria for a real long time. This is a company that is just a basic cigarette company, but you get so much more than just cigarettes. They sell wine. They own a 20% stake in SAB Miller. It's just incredible the numbers that this company posts. And a lot of people, they shy away from a company like this because they think that, people are smoking less and that's it. But they fail to understand that Altria, which owns the Marlboro brand and Parliament in the United States, Philip Morris International is the international arm. It's a total separate company. So Altria is just owning the Marlboro brand, the cigarette company in the United States. People still smoke a lot. I go into every single gas station I go into when I fill up my car with gas. I ask the attendant there, I say, do you still sell cigarettes? And they say, yeah, we sell them like crazy. And every single gas station person I ask, it's the same thing. So they are selling cigarettes still like crazy, and then they're raising the prices. They have extreme pricing power. Now, this is a big company. Altria is a $94 billion market cap company. Huge company. So it's going to be hard to, pretty much triple or quadruple your investment in a short order, but it can be done. I think this company is going to continue to just keep generating massive amounts of cash. What they do is they keep buying back shares with their cash. That's what makes the stock price continually go up higher, even though they're not really a growth stock anymore. The forward PE ratio is 17. On historical standards, this is kind of a little overvalued for this company. I would wait for a big pullback right now. Its operating margins, get this, 47%. Incredible. Return on equity, 107%, although a lot of that is from debt. It's incredible. It pays a 4.4% dividend. So not only are you getting this incredibly rising stock price, you're getting a 4.4% dividend every year. I mean, it's one of the most incredible companies out there. Altria, without dividends since 1980, is up almost 1,000 times. So if you put $1,000 into this company in 1980, without dividends, you'd have $1 million. With dividends, it'd probably something about 2 or 3 million. I mean, it's ridiculous, this company. And I think that in the future, this company is going to continue to make shareholders wealthy. One of my largest holdings is Altria. I've owned it for about 12 years now. You could own it direct from computershare.com. That's their transfer agent. I didn't always own it through them. I actually owned it through a broker for a while, and now I actually own it through ComputerShare. It's just you transfer the shares over, and then I actually bought new ones, and you could reinvest the dividends that way. They automatically get reinvested. So look at Altria. It's an incredible company. And I'm telling you, if you want to cash in on a cigarette and this e-cigarette boom, this is the company that's going to do it. They own Green Smoke, which is another e-cigarette company. It's like one of the best ones out there. And they have the licensing agreements from Philip Morris International, which is coming out with this incredible e-cigarette product this year. It's called iQuos. They're marketing it like it almost looks like an Apple iPhone. The package it comes in, it's incredible. And what it does is it doesn't burn the tobacco. It still uses tobacco, but it heats the tobacco, so it's less carcinogenic. Now, the CEO of Philip Morris International has said that he does not. He's a pack a day smoker, but he does not smoke regular cigarettes anymore after he tried this new iQuos product that just heats the tobacco. And he says that that's all he smokes now. So Philip Morris International is licensing the technology to Altria. And Altria, in return, lets them license the Marlboro and Parliament brand names to them overseas. So they have a kind of a thing going on. They used to be one company under Altria, but then Philip Morris International, they broke up. They broke off from them, and they're just the international arm now. So it's these cigarette companies are cash cows. They're incredible companies, and me personally, long term, I think they are going to continue to make a lot of money, and they just keep buying back shares, destroying the shares outstanding, which makes the earnings per share number higher, which gives you a higher ownership in the company if you own shares. So look at Altria. Again, they own a 20% stake in SAB Miller, which is another incredible company. Just a Vice stock, owning more Vice stocks. I mean, it's great. So look at this company. I own a big position in this. Definitely do more research for yourself for it. Doesn't mean just because I say it on here to go out and buy it. I would let this company come back on a big pullback again. It's been ramping up over the past few years, big time. But any pullbacks, this company will continue, I think, just to keep ramping up in the future. And they increase their dividend every year. So you're just getting an incredible company in one. Okay, another one of my favorite Vice stocks is an alcohol company, and this is Boston Beer Company. They're the company that makes the Sam Adams beer brand. Incredible company. The thing I love about Boston Beer Company is it's only a $3 billion company. You look at Anheuser-Busch, that's a $178 billion company. Ambev, which is the Brazilian alcohol company, $100 billion company. SAB Miller is a $56 billion company. And then you get little Boston Beer Company, which pretty much their beer outranks all these other beers. It's only $3 billion. So the potential for a future buyout in the future is huge, or just Boston Beer Company growing into one of the big behemoths, stealing away market share. So this company can technically be a $100 billion company in 20 years. And that would mean about 30 times on your investment. So if you put $10,000 in this company, you could be looking at $300,000 in the future. Now, I'm not saying that's going to happen, but I'm just looking at the statistics of these other alcohol companies, and this really can happen. So, I mean, the company sells alcohol beverages primarily in the United States, Canada, Europe, Israel, the Caribbean, the Pacific Rim, Mexico, and even Central and South America. So a lot of people don't know that the Boston Beer Company pretty much sells internationally. And they sell pretty much like 50 beers under the Sam Adams name, and they have 10 flavored malt beverages under the Twisted Tea brand name. They have 8 hard cider beverages under the Angry Orchid brand name, and it sells its products through a network of wholesale distributors who then in turn to sell to retailers such as bars, restaurants, grocery stores, convenience stores. So the company was founded in 1984 in Boston, Massachusetts. So that's where it gets its name, Boston Beer Company. It's got really good financials. Its return on equity incredible. It's at 25%. It's a little expensive right now. Its forward PE ratio is 29, and I think it's trading at like pretty much over three times their growth rate. So it's a pretty expensive stock right now. I would wait for a pullback. I own this stock. I wouldn't dream of selling any of these shares, no matter how overvalued they get. These are companies that when you're older, you tell your grandkids that you either still own it or that you used to own that company. Say they get bought out by another company, and then you own shares of the buyout company. But the bottom line is I own this company, and I am never selling the shares I own. The great thing about this company, you could buy direct through computershare.com. Their transfer agent used to be Bank of New York Mellon, but then when Computershare took over all of the Bank of New York Mellon accounts under the Computershare transfer agent name, now Computershare has a lot more companies that they're the transfer agent for. So you could buy this company direct. It's great, and you could take ownership of the actual stock certificate. I mean, it's great. Put it away in a file cabinet. Forget about it. Make believe you don't even own the shares in this company. Get the stock certificate, and that's how you will be a long-term owner. The gross margins of this company are over 50%. It's incredible. So again, just look at all the other alcohol companies out there and look how big they are. And Boston Beer Company is basically going to do those same things that the big companies did, and they're going to steal away market share. So when you see all the the Miller Lite commercials on the Super Bowl, and if you go to a baseball game and you usually drink Miller Lite or Budweiser, in the future it's going to be Sam Adams. I'm telling you, Sam Adams is probably going to end up coming out with maybe even different beers, a more lighter beer. Maybe some people don't like the strong beers. They may come out with their own. Who knows if they come out with their own rum or vodka in the future? Who knows? This company has so many avenues to grow, and at only $3 billion, I mean, put it this way: if you had $3 billion cash lying around, would you keep it in the bank or would you buy this company? You would probably buy this company. You'd be crazy not to. So you're going to continually see big investors build big positions in this company. That's why it's trading at such a high valuation, is because all of these hedge funds and these pension funds and mutual funds, they know they want to own a piece of this company, and they'll pretty much, it's showing you that they'll pay up at any cost, because they know the future is extremely bright for this company. And I'm telling you, 20 or 30 years again in the future, and pretty much like all the companies that I'm talking about now on this video newsletter, these are all long-term sustainable companies that are going to be around for the next 50 years. And that's if they don't get bought out, or if some kind of management doesn't come along and make disastrous policies and destroy the companies. But I don't think they're going to do that. This, again, Boston Beer Company, one of my favorite companies out there, and it's a company you could own for the long term. General Mills is one of my favorite least volatility stocks. And this is a great company to invest in if, say, you have large amounts of cash and you are unsure where you want to leave your money and you do not want it just sitting in a bank. General Mills is an excellent place to park a lot of that cash. It's got extremely low volatility, but it has good growth, and it pays a 3.2% dividend on top of that growth. Now, General Mills makes, as you all know, it makes cereals, it makes frozen breakfasts, pizzas, frozen entrees, yogurt products, ice creams, baking mixes, nutrition bars, and they're also into the organic area too. They actually recently just bought Annie's. You'll see them in Target, the Annie products. They make like those organic snack crackers and stuff like that. So they bought that company for $820 million. And I think over the long term, this buyout's going to definitely be very rewarding for General Mills shareholders. The company's been around for a long time. It was founded in 1928, and it's based in Minneapolis, Minnesota. They sell a lot internationally to like South America, mostly like Latin American markets and the Caribbean. But it's a $31 billion company, pretty large company, but it's extremely stable. I mean, most people that feed cereal to their kids and snack bars, and even themselves that eat cereal, they're not really going to wake up one day and just buy a different cereal. They usually stick to the same cereal that they use every morning. So this is why it's such a stable company. It's got about 15% operating margins, excellent return on equity, which is 22%. And again, I love that 3.2% dividend yield. If you look on this chart, you'll see that the 1987 crash I highlighted on here, in the long run, it's extremely insignificant. And this is what I want to try to show everybody, that don't worry about little corrections here and there. the long scheme of things, it turns out to really be nothing. If you look at General Mills too, it's increased 100 times without dividends over the past 30 years. And like I said, that's really just from investing in simple things like cereal. You don't need this crazy technology product with the hottest new trend and stuff like that. You just need to invest in basic products that have been around for a long time. And General Mills is one of these companies that I think will be around for the next 100 years. This is a stock that you could own and go to sleep at night and not really worry about your investment. And sure, during a bear market, the stock will go down, but not really much. If you look at General Mills during the 2008 and 2009 collapse, it didn't really go down that much. And when that correction ended, it ramped back up and made new highs extremely swiftly. So this is just a company, if you do not really know what to invest in, General Mills is an excellent low volatility company to put your money in. I'll talk about more low volatility stocks coming up after this, but these low volatility stocks are really what I like. And I started off this section in the video newsletter with the industrial type stocks, which are probably the most volatile of them all, but they do have really good growth potential. But really, a lot of these grow just as much, if not more, than a lot of those industrial stocks. Then I went more towards the vice stocks that we talked about. And now I'm talking about more of the low volatility consumer staple type stocks. And these companies continue to deliver incredible shareholder returns with the least amount of risk. Colgate-Palmolive is another one of my low volatility favorite stocks. It's one of those stocks that really have low volatility, but over the long term, they have incredible gains. So again, this is another company that if you have large amounts of money or you want to invest for your college, for your kids, maybe instead of opening up a 529 plan, although with that you might get a state deduction, but at least with a 529 plan, you lose control of the money. And if you don't use it for college, you're penalized on it. Whereas, if you invest in these low volatility type consumer staple stocks for your kids, then over the long term, you could build a really good amount of money. So Colgate-Palmolive, excellent company. They make, as you all know, toothpaste, toothbrushes, mouthwashes, dental floss. They sell a lot of products to dentists. They make deodorants, shower gels, liquid hand soaps, laundry, dishwashing detergents. I mean, these are things that you cannot really live without. If you lose your job, you're still going to buy toothpaste. It's such a small amount of money that's not something that you're going to forego. You're going to forego other things before the toothpaste. Another really incredible thing about this company, and I actually didn't even realize this, it was founded in 1806, which is pretty incredible. I mean, we're talking about over a 200-year company. And it just seems that the older the company, the better investment it is. I mean, when I do my investments and I investigate companies, I love these, 100-year-old companies. I think that they seem to be some of the most stable investments, have the best brands, and are the best well-managed. Now, Colgate-Palmolive is a $60 billion company, so it's a large company. Okay, so you're not really going to put money in it and double your money in a year. It's not going to happen. But if you want a low volatility way of investing where it's pretty much set it and forget it and you don't have to worry about your stock portfolio collapsing. You look at in 2008 and 2009, again, just like with General Mills. I mean, Colgate-Palmolive rarely went down that much. It went down, but hardly that much. I mean, this stock has a history of barely never going down. I mean, look at the stock chart. It barely never goes down. It's incredible. I have a portion of my money in this stock. I reinvest dividends. You could buy it through computershare.com, their transfer agent. I have recurring money getting taken out from my checking account that goes right into this company. This company, again, has operating margins of 25%. It pays over a 2% dividend yield. It's got return on assets of 20%, which is incredible. Its forward PE is about 20, which is not cheap considering its growth rate, but investors are willing to pay up for this type of stable company. Again, don't get this confused. The ticker symbol for Colgate-Palmolive is CL. So don't get it confused with CP, which is Canadian Pacific Railway, which, although that's a good company too, we're not talking about that right now. These are extremely good low volatility stocks. And look, if you build a stock portfolio, a good thing to do is maybe build a stock portfolio with half of your portfolio with stable stocks like the General Mills, Colgate-Palmolive, things that are more stable, and maybe own a little cash, and then the other 30 or 40% of your portfolio, you could buy other stocks that might seem a little more risky. Although they're more volatile, if you own large amounts of Colgate-Palmolive and say General Mills, your portfolio is not going to have huge swings. So you'll be insulated from a lot of these big bear markets. And then when these big bear markets come, you could actually always sell a little bit of these stable stocks and then put the proceeds into the more volatile stocks that have high growth. Say those stocks might have corrected 50 or 60%, they went down, whereas Colgate-Palmolive only goes down 10%. And now you say to yourself, well, you know what? I'm going to sell a little Colgate and maybe buy some more Flowserve or Boston Beer Company. So, when you own these stocks, that's what insulates you from volatility, and you're able to deploy cash when there's a lot of big bargains in the market. If you had all of your money in extremely volatile stocks, well, when the market has a big bear market, you might bail at the worst time. So owning these types of companies rewards you in so many more ways than just returns. It rewards you in a low volatility sense, and it rewards you in a sense that you'll always have cash available to buy stocks on corrections if you own these type of companies. The waste management industry is an extremely interesting industry that I like, and these next two companies that I'm going to talk about are extremely interesting. We started off talking about industrial companies, then some vice stocks, consumer staples, but now these waste management companies I'm going to talk about, these are pretty good solid growth companies that are doing some really interesting things that I like. This company, Stericycle, which was founded in 1989, so it's not really an old company, but it's an incredible company. What they do is they collect and process specialized waste for disposal services, okay? They offer reusable containers for like syringes, and they deal with pharmaceutical and hazardous waste disposal, medical safety products, and they deal with this disposal stuff for hospitals, blood banks, pharmaceutical manufacturers. They deal with veterinary offices, municipalities, retail pharmacies, and they operate in many countries. They're in the United States, Argentina, Brazil, Canada, Chile, Ireland, Japan, Mexico, Portugal, a whole bunch of countries. And this whole medical waste industry is extremely interesting. The financials this company has are, again, incredible also. It's a $10 billion company, so there's extremely a large amount of room for growth. It's not this behemoth $200 billion company. It's a $10 billion company. It's got a forward PE ratio of 26, which really isn't that bad. I mean, its price earnings to growth ratio is under 2, so it's actually trading at below 2 times growth. Its operating margins are 25%, and its return on equity is about 18%. You can't buy this stock direct. You have to buy it through your brokerage account. It's a very incredible company. Like I said, the medical waste collection industry is very regulated. So not anybody could just pop up in this industry and become a competitor. There's these companies like Twitter or even Facebook, and a lot of these technology companies, other people could just pop up, make a new website, and now there's a new photo sharing app. So whereas everyone thought Facebook was that's it, then Instagram pops up. You can't do that with these type of companies. And I'm sure, as you've noticed by now, all of the companies that I'm recommending, they're very hard. The barriers to entry for competitors is very hard. You can't really compete with most of these companies. They've been around for a while, and they've built up with great management, a lot of clientele and a lot of customers, and it's very hard to take those customers away. So Stericycle is just an incredible company. It's up over 60 times since 2000. So for anyone saying that the stock market's done nothing since the year 2000, I mean, could you imagine putting, say, just $5,000 in this stock in the year 2000, and now you have $300,000? It's just incredible. So stocks like this, you don't need to put a lot of money in them to see a lot of growth in your portfolio. All you have to do is be a long-term investor and hold these companies for a long time. And this is why I'm saying it's not hard to beat an index. It's easy to beat an index fund if you're an individual investor. If you have to own a mutual fund, you could only put, you can't put more than maybe 2 or 3% of the mutual fund's money in any one stock. When you own individual stocks as an individual investor, there are no rules to that. So you get one of these stocks that go up in value, 10 or 20 times over a decade. I mean, that's going to boost your returns like crazy. So your average annual returns will come out to be 20 or 30% over 10 years, whereas an index fund may be, giving off 6% returns. So the way to build wealth is like this: buying individual stocks and holding them for the long term. And the goal of this investment newsletter is to give you ideas to spark interest in investing. It's not a tell-all newsletter that tells you everything about investing. If you want to learn about delving more into reading company balance sheets, just go buy a book on that, and you could do it. But no book is going to offer the amount of information that the dynamic amount of information that I present here. You're going to get a whole range. That's why I call it, this is like a whole investment program, this newsletter, because most books are they're geared towards one thing, and they don't tell you the individual companies. That's the problem. Most books, they'll never put their neck out and say that they like an individual company. They'll show you some balance sheet of some, Frank's lemonade stand, showing you how to read a balance sheet by using some, mock-up exercise of some fake business of like some sandwich shop or lemonade stand. But they never really tell you what makes a business good, what to look for when you're investing in the stock market. Should you look at newer tech companies, or should you look at these old industry stocks? And I'm telling you, look at the old industry stocks and stocks that have been around, and stocks that are not in the public display on CNBC. You're not going to see Stericycle on CNBC. It's a boring company. They deal with medical waste. There's nothing sexy about this company. So these are the types of companies that will build your portfolio over the long term. I mean, anyone who invested in this company in 2000 is sitting on a really nice chunk of change right now, and they didn't really have to do much. And the volatility of this stock was low. I mean, if you look at it, rarely declined that much. I mean, it just went up for the past 15 years straight. I think it's going to continue to go up. This is an incredible stock. So again, keep these other type of companies in mind when you're looking for potential future investments, and always keep the boring industries and the boring stuff in mind, because boring is what makes you money. It's not sexy. It's boring industries that kind of deal in weird stuff, and that's usually what makes shareholders the most amount of money. This last company I'm going to talk about in this newsletter is another very interesting company that I own shares in. It's called Waste Connections, and what they do is they're a municipal solid waste company that provide solid waste collection, transfer, disposal, and recycling services. Basically, the people that come to your home or your business and picks up your garbage, that's what they are. And that's why it's an extremely stable company and an interesting company. So they own and operate transfer stations that receive and compact and load waste to be transported to landfills, and they treat and recover disposal waste resulting from oil and natural gas exploration and production activity, I get drilling fluids, drill cuttings, completion fluids, and flowback water. And they own 148 solid waste collection operations, 66 transfer stations, 7 intermodal facilities, 36 recycling operations, 55 landfills, and 20 exploration and production liquid waste injection wells. A lot of stuff. And they were founded in 1997, so it's a fairly new company that I think has big potential for growth. It's a $6 billion market cap company, so it's got huge room to grow. It's got a forward PE ratio of 22, which I think is great for the stable industry of this waste management. And its price earnings to growth ratio, it's less than 2 times growth. Its return on equity is about 11%, a little lower than I usually like to see, but I'm willing to take a lower return on equity for the stability of the business that they're in. Even their return on assets is pretty low. I think it's around like 5. It pays a 1% dividend. You can't buy this stock direct. You have to buy it through a broker. But it's an extremely interesting company, and they continue to grow and get new customers. And most of their customers really, they enjoy the service they're getting from Waste Connections. Again, go on their website, read the annual reports. But this is definitely a company that you own a few shares in for, hold it for decades. And you don't have to own that much. Just own as little as you want. But just hold it for a long time. And it's something that could be the next big company in 10 or 15 years. They will be getting more customers. They may be buying more landfills. And all these landfills are real estate they own. So the assets on the books sometimes doesn't show up within the stock price. The market has been valuing this stock accordingly. They pretty much get it. A lot of investors get it. They understand that this is a good industry to be in. I mean, it's almost like I was talking about earlier with Colgate, with toothpaste, that people have to buy toothpaste. Well, same thing with garbage disposal. There is no, I'm just going to leave my garbage on the street and not pay anybody to pick it up. You have to have somebody pick it up, or else you'll pretty much get fined. So there's no way around this. That's why I love these type of industries. These industries where, like, as they got you. There's no way around it. Not everybody has to buy a cell phone. Not everybody, has to go out to dinner. But people have to have waste disposal services. So look at this company. It's definitely doing some interesting things. Visit their website. They have some videos if you want to get, know more about what the company's about. And that's what I do. I always visit the website to all of these companies I invest in. Just, see what the company's about. Sometimes if you don't want to read the annual report, they just have the yearly shareholder report. And it's great. You get a lot of great information out of it. But these types of companies, again, like I said earlier, these are the companies you own where you don't have to own an index fund. You just own, good quality companies like this, and you will beat the returns on an index fund any day. And this is what I want investors to look at. I want investors to look at the types of companies that I went over in this video newsletter. They're simple to understand companies. Nothing is hard to understand about a garbage pickup, or toothpaste, or beer, or cigarettes. If you notice, there's the same theme amongst all the investments that I'm talking about here, and the theme is simplicity. When you keep things simple, you don't have to, worry about being blindsided about some weird event. There's not really going to be a weird event involving many of these companies. They're simple companies, and they're just run accordingly, and they make money for shareholders. They buy back stock. They do a lot of good things. They're shareholder-friendly companies. I'm not talking about the Bank of Americas for a reason. Those are crap companies that, will make you go broke. All right? The XMSR, satellite radio, crap. Twitter, although sometimes I like using the service Twitter, is it going to make money for shareholders? I don't know. Maybe you own a little of that, but in the long scheme of things, I just think it's crap. I think most of the stuff out there is crap. There's not many great companies that you can invest in for a long time. So I hope that all of these stocks that I talked about, get you interested in trying to find other companies and other stocks, okay? And in the next section, we'll talk about different things, like I'll talk about short selling and a few other things to wrap this video newsletter up. But, I think we covered a real lot of information here, and to really get your hands around the whole do-it-yourself investing type thing, because this is where the future's at. The future is at you having to understand how to do it yourself. You have to. There's no excuses anymore. Some things need to be done by yourself, that they cannot be outsourced. And your financial well-being and how you invest your money cannot be outsourced, because you are the only person that cares about your money the most. Nobody else. Any other type of planner is just trying to get fees off you. They're going to try to get you to churn your account, meaning to have you buy and sell. Because if you're not buying and selling, you're not making the broker or planner any money. They get a certain commission and fees every time you buy and sell stock. So of course, they're not going to tell you about the merits of long-term investing. They'll tell you buy and hold is dead, which is complete nonsense. I mean, just look at all of these stocks I've showed you. Over the next 10 or 20 years, they're probably going to have the same performance, if not the exact same, but if they keep doing things right, they're going to have an excellent performance. So just be careful, and in the next segment, we're going to talk about just some bonus material, short selling, and if you do want to own an index fund, what fund should you buy, and I'll talk about a few of those things. So I hope you enjoyed this part of the newsletter.